Aisha, after Friday's Armageddon, is it time really to put money to work? Is risk back, or this is volatility, and for a long-term investor, volatility, which is always considered to be his best friend, is actually there now to greet you. So today, like we've been indicating to our viewers, that we are coming live from India's biggest AMC to decode Friday's sell-off and where opportunity lies in the market. But equally important, I have with me one of my favorite market commentator, S. Naren, who always has this Mr. Contrarian approach, because this time around 6 months ahead of the fall, he told our viewers that get cautious, the markets were due for a fall. So Naren, thank you for having us at your office. It's a lovely office. So this time you told us 6 months ago that a fall was coming fast in your seatbelts. The fall has come on Friday. Do you think this is the beginning of a decline, or this is volatility which is back? There is no risk per se.
Market is not still cheap. I mean, we have a framework which is that when market is cheap and there is panic buy, there has been panic on Friday, but market is still not cheap. If you look at the market today, we are closer to the all-time high than we are at a situation where we can say that the market is dirt cheap at this point of time.
That's only Nifty which is at an all-time high. Small and mid-cap stocks have corrected, the indices have corrected 25 to 30% now.
But if you look at the small cap indices, I think they've gone up 200% in 5 years. So obviously they've corrected 20% from the top. But the fact is that I don't think yet we are in a phase where we can say small caps is cheap, put your money in small caps. I don't think we are yet in that phase at this point.
So what did you do on Friday? Did you just look at the screen? Were you a buyer, or you were slightly confused given that there could be a liquidity crunch?
See, we have some models, like on those models, obviously the models will tell us to buy on Friday because the sense of fall was not small. I think small cap index fell more than 3-4%. So our models did tell us to buy, and that's the framework we believe. Because what happens is, the more and more you rely on emotions, then you would have never managed to sell in January, February. Whereas, so that's how we are structured, and that's why our models will tell us to buy whenever the market falls.
Okay, the Harvard Mark room here, okay, which we always talk about with Esther. So I'm going to read a quote of this Harvard Mark room. The camera is going to pan in here. The safest and the most profitable thing to buy something when no one else likes it. So I'll say it again, the safest and the most profitable thing to buy something when no one likes it. I can't say this for equities right now, but I can say this for debt right now.
Yes, certainly. I think short duration, ultra short duration debt where you invest for 1 to 2 years, I think clearly is something where people haven't been putting money. And that's an area where actually you have not seen money for a long period of time. So I would say that's an interesting area.
What is your understanding of the IL&FS issue and the liquidity crunch? Is there a liquidity crunch, or you think what markets thought or what markets are perceiving as a crunch was just an aberration on Friday?
See, I think more than talking on specific companies, I think we always go to our guru Warren Buffett. He says two things. It's only when the tide turns you know who's swimming naked. And if you look at it, when US increases interest rates, that's like the tide turning. And you're seeing the impact of it in all the areas where people have not managed their monies well. So if it's a country like Turkey or a country like Argentina or Venezuela, everything goes down. Here there are companies which have been not so cautious, and the companies which are not so cautious, those are the companies which have actually suffered the most.
Naren, a very basic plank on which markets rallied last year and this year was that interest rates will remain low, liquidity will remain surplus, companies will have benefits of operating leverage. But if interest rates they go higher, and Buffett says that interest rates they act like a gravity, which means they will have impact on valuations and they will have to impact on earnings, then equity markets should underperform. I mean, what happens in this kind of a market? Because the companies which don't have a debt are very expensive, and companies which promise you an operating leverage, they will get hit because of high interest rates now.
So while I agree with you that markets are not cheap, you have to remember earnings will go up.
Okay.
Even the quarter that earnings has happened, I don't think earnings has been bad. And I think about 6 months from now, a lot of NPL driven earnings decline, they are likely to go away. And when they go away, that is going to give a kick up to earnings over a period of time. And I think so, actually there is one positive. So what I learned is there's a word called financial conditions. Now financial conditions are tightening. Why are they tightening? Because crude oil is going up, because dollar interest rates are going up, because dollar is going up, you have an impending election, you have Indian interest rates going up. So everything in financial conditions are tightening. On the other hand, you have earnings going up because for 4-5 years you didn't have earnings. So I think earnings will go up, and that earnings will actually ensure that you don't have any big you won't have any big fall except in overvalued stocks, because you have earnings support coming through in the next few years from an economic cycle point of view.
Okay, so from Howard Marks we moved to Warren Buffett, and I would just mark another. I like what they've put here. Okay, there's a Charlie Munger room, there's a Howard Marks room, and there's a Warren Buffett room. So the quote here is that we don't have to be smarter than the rest, we have to be more disciplined than the rest. And the model framework which you talked about, that you follow not emotions but you follow a model, a system which is cast in stone. So you buy stocks not because you like them, you buy stocks because your models are telling you to buy, your models are telling you to sell. So what is the model currently telling you about NBFCs?
See, the model on NBFC says that equities are very overvalued.
Okay. But
And
are models accounting in earnings recovery also?
No, in those cases, when you talk about earnings recovery is for the large caps and for the banks.
Okay.
So if you look at NBFCs, their cost of borrowing is going up substantially. They had no credit cost at all in the last 5 years. So if they have a few increase in credit costs, that is also going to work against. So everything works against NBFC equity at this point of time. And that's what we've been saying for quite some time. So if you look at our portfolios, you will find that we have virtually no NBFCs in our portfolio, primarily because of this. So I don't think there is any case at this point of time to say equities are in NBFCs or HFCs are cheap. In general, what we have seen, we believe that if in any sector too many new entrants come up, we believe that that sector you have to be careful. So if you look at HFCs, that's the area where the maximum number of entrants have come up, and you don't know whether they are actually behaving sensibly. So Warren Buffett says if other people are acting sensibly, you are safer, but if other people are growing because they want private equity money, etc., and they're growing without looking at credit risk, I think there is a challenge. That's why I would say that NBFCs and HFCs are okay on the debt side, because they're giving you the highest interest rates. And sometimes even in AAA you get good interest rates there, but I don't think on the equity side there is any case at this point.
So greed